Good morning, everyone. I've somewhat recovered, which is great, and I've got Nigel with me as well too. So I think the way it's going to work is for those of you who are familiar with our format, we will run the presentations, and by all means, shoot through all the questions as we go, and certainly we will answer the questions at the end, and obviously the hard ones I'll pass it on over to Nigel. But yeah, we will try to answer all the questions as much as we can. How are you, Nigel? Good? Yeah?
I'm good, thank you.
All right,
Morning
good,
all.
good recover. So we had a great sort of budget night, and the after party was pretty good, just the two of us. And certainly, look, we had a bit of a celebration of the end of the budget. And firstly, this is my 10th budget delivery from at Netwealth. Not quite sort of Peter Costello 12, but I'm sure I'll get there. And certainly the other celebration we had together with Nigel after party was really not much change to super. But having said that, please do not log off, until we finish the last slide, because I think I will have a few things to share with you. So look, it will take, I thought it would be 10 minutes, but obviously it will be longer than that, but hopefully we'll come on time. So the outline that we'll do this morning, I'll sort of make it easy for you just to break it all up into the changes that it impacts on the tax, obviously individuals and financial planning. Then we'll cover a few slides on super. And last but not least, a couple of things, a couple of areas we'd like to share with you on Social Security. And at the end of it, just one slide, just to sort of recap who the winners and losers are. And once we've done that, it'll be question time. We'll address some of the questions. We'll address where we can. If not, then we would also directly email the answers to you. So that's the format that we will take during this webinar. So if that's okay with you? Okay. So let's move on to the tax, which was really the main frame of this budget, and I thought the best way to look at this is, and in fact that's the way it's been presented to us, is really really a three steps tax process reduction by way of a relief offset, which I'm going to take you through, and it's actually over a seven-year period. So on this first slide here is pretty much the first step of the changes, and I've summarized it on the table that you can see in front of you. The column in pink, the changes, what we have now currently, obviously the rates as you can see, and certainly the different tax thresholds. So on top of that, we have the low income tax offset. So for those who have forgotten about low income tax offset, is one which is given to you obviously based on lower income up to 37,000, and at the moment it's $445. What they have done in order to give that relief immediately is from 1 July, which is in the next financial year, is to provide an additional tax offset. I know at some stage we had something like 20 over 30 over tax offsets that have been reducing it, and this is a new one which is now being introduced for this purpose, and it's called a low and middle income tax offset. Remembering that this is in addition to the LITO, so that's still available. So, but from the 1st July 2018 onwards, and in fact for the next 4 financial years from the next one, that this low and middle income tax offset will be available. Remember that this is a non-refundable tax offset, and the way that works is the maximum of $530, and the relief is given to individuals in the form of, if someone earns less than 37,000, the relief is $200, and in between 37 and 48,000, it's sort of increased 3 cents for every dollar over 37,000 to a max of $530. So if you're close to about 48,000, then the relief on the low and middle income tax offset is $530, and in between the 48,000 and 53,000 on, then there's a full benefit of that $530. So 48 to 90,000 is a full $530, and then from there on, 90,000 and $1 forward up to 125, 333, the offset sort of reduces at 1.5 cents per dollar. The reason why it's being done that way is just to try to focus on the relief being given to the low income and then the middle income, and obviously capping out after 125,333. Yeah. So if you can see it that way, then you can see why it's being done that way, is to give a max of 530, and it's for people in between 48 to 90,000, and either side of those, obviously the relief is slightly less, but that's really trying to focusing on the relief being given to low and middle income earners there. You can see that beyond that, there's no relief whatsoever. Right. On top of that, you can also see that that 87,000 threshold currently that we have has gone up to 90,000 as well too. So therefore, there is a little bit of relief available, if you like, for pretty much everyone above 90,000, and in fact after 125,000, simply because we've moved that threshold 87 to 90,000. So that's the immediate relief that's given, and you can see it's being focused for the next 4 years, and that comes under step 1. So then, if we move on to the step 2 of the process, then again, I'm trying to make it easy for you, is then you can make a comparison of what the current one is, which is the first column of numbers, and then the second column, which is now in blue, that's really showing you the changes over a 4-year period. And you can see, well, I'll exactly replicate the slide before, which has gone 87 to 90,000, and that's the move, which also compensate for the step 2. So step 2 is about bracket creeping, right? Bracket creep, and that's trying to protect against bracket creep compared to step 1, where we were focusing on relief and given immediately for lower and middle income earner. So step 2 process is about trying to reduce the impact of bracket creep, right? So the pink, again, the last column, is showing you how that's being done in step 2. So if you look at the right-hand side, how does that work? As I said before, we had this change, which actually took effect from 1 July 18, is to move the threshold for the 32.5% threshold, the top side of 32.5% from 87 to 90,000. So that also allows for partly the bracket creep protection. But from 1 July 2022, on top of obviously the low and middle income tax offset that we've got for 4 years, and in 4 years' time, 1 July 2022, the low income LITO, that's the 445 that we have now, will actually be increased to 645. And at the same time that the LITO is increased to 645, the low and middle income tax offset disappeared, right? So remember, the 530 low and middle income tax offset will only be with us for 4 financial years. At the time when it finishes, 1 July 22, then the low income tax offset is also increased at the same time from 445 to 645, as you can see in the pink column there. Yeah, and there are a couple of movements on the thresholds as well. So again, from 1 July 2020, that 19% threshold we have at the moment, which is 37,000, will be moved to 41,000. And the reason for that move from 37 to 41 is actually accounting for the low and middle income tax offset that we got rid of. So it's actually locking in step 1 benefit, right? So look, in a way, it's pretty clever there. I wouldn't have thought about all this, but someone obviously did back in Canberra and the ATO. So pretty much that 37,000 moved to 41,000 will actually seal in that low and middle income tax offset, which disappears at the same point. And at the same time, 1 July 2020, then the threshold for the 32.5% threshold will move from 90,000 to 120,000, 1 July 2022. Yeah, so that's summarized in the pink columns there, what the changes are. So litre will go up 645, and a few of the thresholds would move there. So that's really accounting for the bracket creep protection. Now, the whole process will come all together in 1 July 2024, right? And how does that work? So we've had the low income tax offset increase to 645. Our low and middle income tax offset has disappeared since 2022. Then from 1 July 2024, in order to simplify the tax system and in fact simplifying the tax thresholds, then the idea there is to increase that 32.5 or widen the whole threshold for 32.5% from that 41,000. So we had 37,000 at 19%, going up to 41,000 for 19% in the previous slide, and now the 41,000 at 32.5% will be expanded to 200,000. So it's a fairly wide scale there at the 2.5% at 200,000. So in fact, I think if you read the media, that pretty much 94%, I believe, of taxpayers would be paying no more than 32.5%. And that's the reason why, because we are actually moving up the threshold where the top tax rate cuts in at 200,000. At the moment, it's 180,000. So 200,000 at 45%. So in effect, by then, we would only have 4 different tax rates, being 0, 19, 32.5, and the max of 45%, which hasn't changed, at anything greater than 200,000. Obviously, let's not forget we have the Medicare levy as well on top of that. Yeah. So all up, it's a 7-year program, and pretty much starting off with low and middle income relief, stopping sort of bracket creep being a problem, and simplifying the whole sort of tax thresholds and so forth. So look, I think overall it's a reasonable move, and it is providing, I guess, relief at all levels, where it's more or less. So in terms of us thinking about the impacts and on our clients, let's not forget the non-refundable tax offset, other than when we do move the thresholds, which really then providing a direct tax benefit. Let's not forget these tax offsets are non-refundable. Therefore, if you didn't have any tax to obviously be offset, you will not get a refund on that. It is not available to non-tax residents either, so it's only Australian tax residents that would all tax offsets are only available to tax residents. This includes this new one here, and it cannot be used to offset medical levy as well too either. So it's got to be tax liability, yeah, XML. Now, I thought I'll just share with you too in terms of the relief, right? Just to show you where the focus is, and in fact, look, obviously it would change as the 7 years, as we travel through the 7 years. But if we just look at 18, 19, and I think that's the easiest one to look at in terms of savings, right? Someone on 50,000 will save $530, so that's the maximum relief available. And someone on 90,000, so middle income, is $665, and someone on 200,000 actually do get something as well too at $135. And the reason why at 200,000 you're getting $135 is simply because there's no tax offset available. But if you recall, we are moving the thresholds for that 32.5% from 87,000 to 90,000. So if you do the maths, then you'll find that that equates to that $135. Yeah. So look, everyone is getting something there, despite the fact that it is for low and middle income earners only, but even beyond that, there's a bit of relief starting from the next financial year. Now that brings into question then, if we then track it through, is there any advantage over the next few years as to what we should think about for our clients, especially when we think about super? Yeah. So I think there is. I think it is important to incorporate these changes, especially if you're doing the planning now for next few years. Look, I think we get a bit tied up with thinking about everything needs to be in super. And I know that I've spoken to a number of you to say that it's not necessary that everything is to be in super. of course, it's given that if you got $1.6 million in pension, then that is obviously top of the list, that we need to be in that 0% tax-free environment. The next level is accumulation at 15%, and that's not bad rate as well too. But having said that, and I've always said it, if you're going to be in super, make sure you try not to die, right? Because obviously death, death duty, if I could call it that, can surface on death if we're not quite careful with the taxable component in it. So on balance, we still got to obviously control and make sure that we're not obviously subject to that tax. So which then brings me to the point that if you're able to have the equivalent earnings outside super, which could be 0% or even 19%, and we're not having to be subject to the tax at potentially 15%, being death benefit tax to non-dependents, then we should be thinking about that as well too. So it is possible that you could have $1 million outside super and say, earning 3%, right? And that gives you $30,000. And if given the new benefit, tax benefit now, $30,000 potentially could be just tax-free. And in which case, I would question why you would have the extra million, even in accumulation, obviously assuming that we used that 1.6, when you could actually have the $1 million outside with the LITO and the lower middle income tax offset, which might bring the tax down to pretty much zero, that you wouldn't have it outside super, right? And we don't have to worry about any taxable component there on death. So we need to think along that line now that pretty much the lower middle income tax offset together with the LITO, which we still have and increasing in due course in 2024, that your effective tax-free threshold, which is 18,200, could be 30,000 and more. I haven't had a chance to do the exact number, and therefore that allows you perhaps to have more balance outside super. Yeah, so let's think along that line in over the next few years, and definitely by the time we get a full benefit of the changes coming through, obviously assuming that this will all go through, and we will see it coming through the whole 7 years. Another point as well too is obviously the arbitrage between sort of lower earning spouse, husband and wife, is to again try to direct as much of the income to the lower earning spouse, and this gives us obviously the offset allows us to divert even more. So I think family trusts and structures such as that will be useful in trying to direct the income through. So those are the few points. They're fairly simple, common sense ones, but something that we can think about over the next few years to see how best, as much as the relief is, it's not huge, but they all add up, and certainly it sort of brings us to think about other areas as well too, and a bit more flexibility in how we can arbitrage the income. So look, I'll leave you with those 3 slides, and you can see the rationale for obviously doing in this way is really trying to focus on the lower and middle income earners, but at the same time, certainly with the higher income are still given a bit of tax benefit there. So look, all I can say is definitely building up towards an election budget. That's for sure. So most generally, people should be happy with the move under this tax reduction plan here. So I'll leave you with that for you to think further. So let's move on. Nothing new. This slide which we put up every year, other than the first point, and we should certainly celebrate the fact that the 0.5% increase, which I think was discussed in the last budget, I'm sure, that was going to apply from 1 July 2019, is no longer going to go ahead, right? So it will stay at 2%. It will stay at 2%, and if you recall, the increase was to fund the NDIS, and which again, if you've been listening out to the media, that again the government said, look, we've had a good year, and we should celebrate. And there's no need, especially that we're trying to keep the tax cut to 23.9% of the GDP, and hence there's no need to have that increase going forward, which is pretty good news. And in terms of the regular indexation of Medicare levy, it happens year on year, and there's other levels, so it's been increased. And in terms of thinking about any possible strategies, I guess, look, especially with this year, this is pretty much the first year that we are able to have, obviously discounting the 10% employment rule as far as contributions is available as deductible contributions being paid by individuals or our clients into super, is one which perhaps that should be considered. And we are in May now, and we've got 5 or 6 weeks to end of June. Is really go back to your clients, and if someone earns $30,000, and you could certainly put in up to $25,000 in concessional contributions, then it may be the case that you felt that yes, we could save 2% by putting in a contributions to bring it below, say for example, an individual below that 21,980, and therefore there's no Medicare levy 2% on the difference between 30,000 and 21,980. So that would definitely work, because the personal deductible contributions would certainly be a deduction for assessable income, and therefore Medicare levy will not apply on that amount. Not forgetting, obviously, the difference between a 9% tax that you would have to pay had it been a salary, and let's not forget too, if you put in as a deductible contribution, there is a 15% tax. So there is somewhat of a savings of 4% plus Medicare levy if you were to put in contributions before end of June. And this year is a simple exercise too, right? We don't even have to think about salary sacrifice by employer, which has always been too hard. Is really just give us a check, right, before 30th of June. A few days beforehand, makes things a bit easier, but we will still accept it as at 30th of June, right? Other deductible contribution expenses will also do the same thing, and certainly is a couple of things that you need to think about if you are trying to obviously save that 2%. So I'll leave you to think about that one. This one again was mentioned last year. This is for small business owners, and that might include yourself as well too, as and the financial advisors. If you're running a small business, it's about this immediate depreciation of assets costing less than 20,000. I think it's a great innovation, and it helps things moving, and it's a good time to think about it as well too in the next 5 or 6 weeks. Applies to business with turnover less than 10 mil. And certainly, if it's an asset which you acquire and install ready for use by 30th of June, so next few weeks. Okay, so these are capital assets which you would normally depreciate over time. This is giving you a one-off purchase and a immediate depreciation. So cash flow wise is pretty good. Well, it depends on when you put in the tax return, isn't it really? But because the amount is expensed in the next few weeks, and potentially you could get back the refund very soon after 30th of June. Yeah. So anything more than 20,000 will have to be put in the depreciation pool, depreciated 15% and 30% thereafter. But as you can see, if you're 19,000, you get a deduction immediately. So it really depends on the tax rates, I guess, you anticipate this year and next year. So work it out. But it is available if you need to be. Yeah. Now, in terms of the assets, most assets come under this. There are a couple of exceptions which probably wouldn't apply too much to us or your clients, but just be aware of that. And come 1 July 19, we'll revert back to the arrangement normally of $1,000. So it's a huge difference. I think it's a huge incentive, and certainly one that you need to think about for yourself in your business, and certainly with your clients as well. And accountants will be jumping on this for sure. Now, in terms of obviously, if we have the additional cash flow, nothing wrong with at the same time, if we expect that if we could recover $20,000 in by way of the tax refund, then at the same time, funding funding super as part of the contributions for the year end, then something which might be useful to think about. Yeah. So any major assets, bring it forward rather than next year, bring it forward a bit earlier, and technically the cash flow wise is good, and you get an instant deduction there. Okay, so let's move on to the next area that we're going to talk about, and super. All right, so good thing we had a pretty hard sort of 18 months with all the changes previously. I think we're still getting over it. So it was a night of celebration because we didn't have too many changes, and there was nothing much that we expected. A couple of surprises, which we'll discuss now, but nothing too major, which was good, right? So we're still trying to get on top of last couple of years. I just wish that I didn't have to show you this slide ever. In fact, it's proposed, if you recall, that we were going to just get rid of it completely, and it would have been much easier, right? And in fact, some advisors thought that came in, but I just want to confirm that it still exists with us. And instead of taking giant steps to get rid of it, when we did have the chance, perhaps a couple of years ago, we decided to do baby steps. This is just another little baby step, right? Well, little baby step better than none, I guess, right? So 1 July 19, no work test will be required for some individuals, so not all, okay? So obviously work test, when we talk about work tests, is really only people who are aged over 65. Pretty much 65 to 74, right? Last time that you could make the contributions, other than mandated beyond that. Now, in order to be able to make the contributions, and they are voluntary contributions, and this only applies for 12 months, really from the end of the financial year when you last meet the work test. So I think the easiest one to look at is someone at age 65, right? And then retire beyond that. So when age 65, work full time. So we pass that test. And under the current rule, then that person, the following year, having not worked at all, will no longer be able to make contribution because you didn't make the work test of 40 hours in any 30 consecutive days, right? So that's the current rule at the moment. But when this rule comes into play, 1 July 2019, then what happens there is, if let's say 1 July 2019, that someone is 66, right? And therefore the year before that person was working full time, then this rule will be available for that year only, right? It's only for 12 months. It's not indefinite either. It's only for 1 year. So in that year, when you think, when you want to contribute and you are over 65, and you are not able to make the work test, you will just then need to look at the year before, right? And in my example, the year before, that person was 65 and working full-time. So we made the work test, and then we can potentially use this rule. But only if then we look back last year again, on the last day, 30th of June, remember total super balance, right? Then at that point in time, the total super balance must be below 300,000, right? So you would need to know the definition of total super balance, and for this purpose, 300,000 and below. Once you've met that, so even if the earnings take you through, let's say you were 290,000 as at 30th of June, and then during a year that you want to contribute and you're age 66, and you had a good year and you went up to 330,000, 10% return, then you can still contribute, right? Because the fact that the last day TSB, you're under 300 and you were working that year. Yeah, so you don't need to meet it again for that year, and you can make the contribution. Having said that, this only allows you to contribute, right? Because the work test should be thought of separately to all other rules. I think in the past it's always been, advisors and clients just mix them up, right? Work tests and contributions. Think of them two separate things. Firstly is work test, do I meet it? Which means I can contribute. So therefore, if and when you can contribute at age 66, then the normal contribution rules come in, right? What are your caps? Separately, that's what you need to think. So let's look on the right-hand side. What considerations there are. So potentially, you are able to extend one extra year to 66. really. Yeah. And in fact, I'm just giving you where it could potentially start. So if I think about this rule as well too, so if someone works on to 67, you can potentially pay in a year that you're 68. Yeah. So someone finished at 65, then that's fine. That's the first year that you could apply. But certainly any time between 65 and 74, if you work the year before, then the next year you can actually make contributions. Yeah. But let's not forget the normal contribution caps rules apply, which means post 65, even though you can contribute, but you cannot trigger the 3-year brought forward. Yeah, so separate thing altogether. So we need to think of 2 or 3 rules separately once you know that you can contribute in the first place. And having said that, then if and when you can contribute, it is voluntary contributions that you can make. And voluntary contributions can be concessional and non-concessional as well too. Yeah, knowing that concessional now, that you can make personal contributions, that will be concessional and you get deduction. So let's not forget that you can put in 100 simply because you're over 65, and then you can have the other 25,000 too. And you can use it in conjunction with other caps. The 5-year concessional cap unused. So if you've been carrying forward, then you could have the 125. You could have $150,000 as well too, if you have not been contributing for the last 5 years. And downsized contributions, remember, don't require the work test. So you got to think about that as well if that happens at the same time. Will be useful for small business CGT contributions, because remember, even if small business CGT contributions, we do need to meet the work tests at the moment. Most instances that's usually not a problem, but just in case there's a time lag that we were not able to meet the work test when we are within the time frame to make the contributions. So this rule would certainly help out there. The order of contributions can be useful, remembering that we need to be below 300,000 in order to use this rule. So therefore, if you had a downsized contribution first, and then we're trying to utilize this rule the following year, we could have a problem simply because we will not be below 300,000. Yeah. Now, in order to maintain that 300,000, you might also think about your clients who are husband and wife situation, whereby we think we need to use this 300,000, and therefore we might then try to super split in terms of balances. If one of them could actually withdraw and recontribute, that is also super split, right? Or perhaps the real super contribution split, which is really trying to keep below the 300,000. Yeah, so all different versions of really arbitrage and equalization, which the one which I always push anyway, that we should be trying to equalize balance as much as we can. Okay, so look, as much as not a lot there, but look, I've got 4 or 5 points that I've mentioned for you to think about there. So it's not bad. First baby step. So let's look for the giant step in the future, and we might not even need to talk about the work test ever. But in the meantime, this is what we've got from 1 July 2019. Protection of super. This is more obviously concerning product manufacturer. And I think, look, the insurers will not be too happy with this one here. A few changes here which you should be aware of, and applies 1st July 2019. And that's changes to insurance arrangements. I think the whole idea of this one here is really about erosion of super balance, especially inactive accounts, whereby, obviously the current scenario that we can see is younger sort of individuals had amounts being paid into their funds, and they had fees taken off, they had insurance premiums being paid, and it ended up being zero or very small balance, and nothing is in the future. So to counteract those changes, the suggestions or proposals are that from 1 July 19 is if there's any accounts which is less than $9,000, or for accounts where the member's under age 25, or inactive, pretty much, no contribution for 13 months, then the default position is that it will be switch off unless the member opt in that they want the insurance. Yeah, so there's 14 months from that point in time to decide. If there's no opt-in, then the insurance will switch off, and obviously no premiums will be payable. At the same time, the fees chargeable, there's going to be a cap on it, and that's going to apply for only funds with balance less than $6,000, 3% annual cap on passive fees. There is an exposure draft on what passive fees mean. I had a quick look at that. Pretty much it includes admin fees and investment fees as well too, right? So it's out. The exposure draft is up for submission. So we'll see what the industry says and what the eventual result will be. But the 3% cap, and certainly in terms of exit fees, in relation to all super accounts, no longer can, from 1 July 19, any exit fees be charged. The last point on that, inactive super accounts less than 6,000, surprise, surprise, transferred to ATO. So if nothing is done, and through obviously what the ATO will try to reunite the balance account, inactive ones with active accounts, where they're able to find the members' accounts to consolidate. That will be happening there. So less than 6,000 inactive will be transferred to the ATO. Now, in terms of the considerations and impacts, firstly, in relation to insurance, I reckon it's a very dangerous move. At the current time, yes, I do actually understand fees erode the balance, right? Certainly erode the balance. But the other side of the coin is that they lose potentially a valuable insurance cover. And some individuals, unknowingly, in fact, they might not even know they have insurance cover. And when perhaps death occurs, and that's when the cover is actually pretty useful, whether they knew it or not. But in this instance, if it's being taken away, and the danger is where accounts, especially when accounts are fairly small, is that those individuals are never going to review, and they're not interested in the insurance cover, and therefore they thought they might have the cover when in fact that might be lost already. So look, it's a hard one in terms of trying to reduce the fees, but on the other hand, when it is important, then the insurance cover is not available. So I guess as an industry, we just got to make sure that our clients are covered and they're well aware of this issue, and therefore have the cover in place where necessary. Now, in terms of consolidation of members' accounts, look, we should do similar things as well. In fact, we've been doing consolidation for years. Maybe this is the last stage of the exercise. And in order that we don't lose that $6,000 or less to the ATO, we should look around ourselves and making sure that we consolidate and help members to consolidate. It could be a marketing exercise as well too, if you are in that space, to seek out new clients, and therefore try to consolidate for them. Look at client accounts which falls into that categories and transfer into one main account. Let's not forget too, right? Normally we thought our big accounts and we don't look for small balances. It is possible that if you have a small balance, that you try to look for a big balance and attract the big balance to come in and consolidate with a small balance. Yeah, so let's all do that at the same time that the ATO is doing that, and that's pretty useful for all clients in any case. So a few changes there that you should be aware of from 1 July 19. A couple of other changes that you should be aware of. SG, the first point, that's always been causing us trouble in terms of employers paying too much, but it's just addressing one whereby you have more than one employer. And this is the case in ones I've come across in the medical industry, whereby a medical practitioner might be operating with 2 or 3 different hospitals, a couple of other employers as well too, and therefore the proposal there is despite the fact that the SG together being paid, and that's obviously the obligation of the issued employer that they need to pay 9.5%. that in total is more than 25,000, that causes the problem for the individual. So the proposal there is from 1 July 18, and so that's coming, is to allow individuals where they have multiple employers, is where their income total exceeds 263,000. That will be obviously 9.5% of 263 is 25,000. Then the individuals are able to nominate wages by particular employers, not to be subject to the SG, right? So obviously we haven't got the specific provisions yet under SG provisions that each employer had to pay. So they'll have to make some changes to the SG legislation to allow employers who would normally be obligated to pay under this proposal not to be paid and not being charged the SG charge under the SG legislation. So that's the first point. The second point is the 290/170. Remembering that this is, remember, when you put in a contributions and you want a deduction in your tax return, especially this year now without the 10% employment rule in place, you must and you need to give us the 290/170 notice before you put in the tax return. Yeah, that stuff. Yeah. Now, I didn't think this was a problem. I didn't think this was a problem because we have been dealing with a number of issues here whereby someone claimed or didn't claim and it flows through the ATO, picks it up quite well. So I'm really not quite sure whether this was needed at all, but perhaps it's a situation that I've not considered. And what the government is saying is people are not putting in the notice, and hence obviously by the fund like Netwealth, for example, then we will not be taking out the 15% tax, right? And it'll be just treated as NCC. But at the same time, on the other side of the equation, the individual took a deduction for it. Okay, so I didn't think that would happen because when the ATO then marries everything up, because obviously we are all servants to the ATO, right? We report to the ATO what contributions come through, and it marries up and they'll deny them the deduction. I thought that's the case, but obviously they're just trying to strengthen up the system in all. So from 1 July 18 onwards, then together with on top of the notice of intent which you need to give us, then the individual will also need to tick in the tax return to confirm that they've actually put in that notice and obviously receive a notice from trustees to confirm that. Yeah, so something that you need to know of, nothing to change in terms of the notice itself, but it's just improving the integrity as far as the government is concerned. So in terms of considering the impact, look, firstly with the SG, it was very, very specific. It was very specific in the sense that it talks about if you are employed by more than one employer, that this provision applies. But I'm not sure this will cater for where you have one employer and you're being paid more than 263,000, whether this could be applied. Because I certainly have dealt with a case where an employer pays a client about $700,000, right? And the employer insists on paying 9.5% of $700,000, right? And therefore we go excess and went back to the employer to say, look, can we just reduce down to 25,000? And the employer just refused to do that. So we keep on having excesses. It's not the end of the world when we have excess, but obviously we'll go through all the paperwork and there's a sort of penalty interest involved as well. So I'm not sure that would resolve that, but let's wait, right? And let's wait for the provisions. This seems to me applies more to have more than one employer. So and hopefully, we'll see how that goes. If it can be done for one employer as well too. Now, in terms of 290/170, so let's not forget that you still got to put it in. This is just an added compliance issue for the individual, and especially this is the first time that we are doing it without the 10% employment rule. So I'm expecting a lot of checks from you guys come 30th of June for those employed clients, whereby they do want to take a deduction for contributions made in the next few weeks, but let's not forget to give us the 290/170. Yeah, so those are the changes there. Okay, let's move on. A special one for SMSF that just came out of the blue, right? Ever since I've dealt in the SMSF space, we know the rule is 4 members. It applies to ATO funds and small APRA funds as well too. It also applies for new ones set up from 1 July 2019. So that will come in 2019. But you will also transition to all funds that exist currently. So if you have funds which are 4 members now, you can have 6 members if you like. I thought it was an interesting measure. I thought it was a really interesting measure. I thought we were already having trouble with 4 members. Now we are on 6 members. And in effect, when you look at it, I seldom come across funds with actually more than 2 members. Yeah. I think, of course, it's a good move if we can have 6 members. And in fact, I reckon if we use it appropriately, it will certainly a boost to the average balance of SMSF. So, and reduce fees, I guess. So 6 members. And of course, at Netwealth, we would have thought about it many years ago, right? So let's not forget our aggregation of 6 accounts. This is exactly where it fits as well, if needed. Yeah. So look, I think it's an interesting measure. I would question how many funds would actually use it, but for a few funds that we can use it, I think it's a significant scope and flexibility. Of course, before we do this, come 1 July 19, you probably would need trustee amendments to ensure that we can have the 6 members there. And if we do have 6 members, I reckon it's a good one that we could certainly utilize for estate planning purposes. You could have a couple of members rolling in. We can make contributions more, and therefore we can transition assets within SMSF, especially if it's a property that we would like to transition to the next generation. But of course, right, it brings in more issues whereby you have, initially now you can have two kids in there fighting with you. Now you can have 4 kids in there, right? So I'm not trying to think of that too hard, but certainly look, in terms of financial planning, not a bad move, and we'll see the progress in this direction come 1 July 2019. So I think that's pretty much all the changes that I need to share with you as far as super is concerned. We'll move on to the last part of the presentation, which is Centrelink Social Security. And it's good. It's good. We celebrate the fact as well too on that night that we didn't have too many changes, and it always confuses us as well too. Family tax benefit A, B, and so forth. But I'm pleased to say that not too many changes. But a couple of ones which I thought that you should really appreciate and think about, and in terms of the changes. Firstly, this is nothing new. This is the pension work bonus. What the pension work bonus is really allowing someone to actually earn income post pension age if they want to top up their additional income. So this allows them to earn extra income and not impact on their pension. So they could get full pension if they're within that threshold. So the way it works, the rules are still the same. What it means is that from 1 July 19, then the amount that you are able to earn before your pension starts being impacted is $250 to $300 per fortnight. It really means if you earn $300 in that fortnight, it doesn't count at all against the income test for pension purposes. And let's also not forget, this is on top of, if you're a single, $168. So in fact, you could earn $468 and get a full pension. That's really what it means. And also for the first time, it's also extending to earnings by self-employed. And in relation to this pension work bonus, unfortunately, it only applies to the personal exertion income, right? So you actually got to be working and sweating, and for this income earned to be not counted. So it's not in relation to any interest that is sitting in your comfortable chair and counting the interest from the bank. It doesn't apply to that, right? So it's got to be personal exertion income. So in terms of the consideration for your clients, all in all, a pensioner, a single pensioner could earn $7,800 per year without impacting the pension. For a couple, that's double that. So look, I think it's good. and it doesn't impact on that, and it saves on the super, not having to withdraw if we need that additional income there. So I'll leave it with that. It's not a change totally, but certainly just a significant improvement that if you're not aware of it, it's something to think about. This is an interesting one, which I think as well too brings out the attention to a lot of people. And simply because it was a bit narrow before, but now with the proposed change from 1 July 19, the expansion of the eligibility, which got me a bit more excited than before. So at the moment, before this change, this scheme is only available for someone who is on the age pension. But from 1 July 2019, it is available to all Australians of pension age. That is a critical change, a big change. What is a pension loan scheme? Really, it is a reverse mortgage solution. It is a government reverse mortgage solution. So it is no different to a reverse mortgage, right? Provided by a bank on a commercial arrangement. This is the government equivalent of it. Okay. Now, as I said, the main criteria is that it's available to everyone, so long as you hit the pension age. Then the amount that is available to be paid out or drawn from so you got a property to be secured, right? So it is a reverse mortgage. The amount that can be payable out to you under the new rules is 150% of age pension rate. At the moment, the maximum is the age pension rate. So that's another improvement on that as well too. So if you're looking for a single person, then the amount that could be withdrawn each year, right, is really the age pension full rate, which is that 23,598 plus 50% of that. That's how I worked out that 35,000. For single, you could actually withdraw 35,000. For a couple, it's 53,000. And once you've done that, then each amount each year obviously could be indexed up as well in the normal indexation, right? So that can increase each year. What's the rate that's payable? So obviously it's not come-free. It's not a tax-free rate. Unfortunately, it's not at a HEX rate. It would have been great if it was at a HEX rate, which is obviously significantly less than that. But the rate currently payable is 5.25%, right? And it's been the same rate since 1997. So in the earlier years, a few years earlier than this year, then when the rates were high, that's definitely a good rate. I mean, that's still not a bad rate, 5.25%, right? And on the reverse mortgage government style. Now, how does that work? So the loan will accrue, so you get paid, your loan will accrue. Just before that, I just want to clarify, I'm just coming back on the left-hand side again, the 35,000, right? So the way it works is, well, at least at the moment, is if someone has got 35,000 and you've got a pension amount of 20,000, right? So age pension, then what this allows you to do is that you have the difference between 35,000 and 20,000. So what I wasn't quite sure is if you didn't have any age pension at all, right? And it seems to indicate that if you didn't, then you get 35,000 because you start off with 35, which is how that amount is calculated, less any age pension. But we need to clarify that, yeah? So, but that's just really letting you know exactly what the maximum could be. So let's go back on the right-hand side again. So you'll be accruing each year, and it's repayable on death, and the property is sold. The loan obviously is repaid back to Commonwealth. The Centrelink will take charge of the property, so they will do that. And in fact, it can be done not just on your home property, but it can be also on investment property as well too. The amount that can be loaned, they have guidelines on that. It depends on the age, and I got Nigel to have a look at that. The LVR seems to actually increase as you got older, and at 65, I think it's something like 25%. At 85 or something like 55%. So I guess, they thought, at 85, they get the money back quicker, so you can have more, right? So the details we can work out, yeah. But it seems to be that case. And if you didn't like to take on the loan, and obviously the kids don't like this either, right? So it can be repaid anytime as well too. Okay. So look, I think it's an interesting scheme. I think it can work for some clients, and I guess The main point with this one here is we come across, and especially for pensioners, you're going to have some pensioners, they could be on full pension and they could be sitting on $1.5 million property, but they just didn't have the cash, right, to do the essential repairs. Yeah. And hence this would actually allow them to withdraw some cash and therefore, renovate the home and to remain in there. So there's a place for it. I know many of you might not be, happy with, reverse mortgages. I think there's a place for it, so long as it suits the client's profile, as long as it suits the client's kids, isn't it? Really, that's the real issue. But as in terms of financial planning and in terms of obviously some cash available to client, I think reverse mortgage as a whole, to me, the concept seems okay. And especially that this is being done with a government style. And in fact, the rate as it stands at the moment is about 1% lower than what you could get at the bank, right? And as I was saying before, this rate has been the same since 1997. So the rate certainly should be better than any rates you can get out there if you're thinking about reverse mortgage. And certainly, I think it's one which could be used to top up their retirement income. And certainly, I would hope that the fees, if compared to if you did it with a commercial lender, would be probably significantly lesser doing it this way. So something to think about. Some clients would fit. And certainly one to, especially with now the expanded eligibility, which is really everyone above the pension age, never mind whether you're getting age pension or not. So something which I think should be considered. So those are the only two things I want to get you to think about as far as Social Security is concerned. So finally, last slide, a quick rundown of winners and losers. I think you could guess for yourself anyway, right? If you've been following me through the whole session, you would have got the same list as me. So the winners will be obviously the low and middle income earners. We know that. Older Australians, small businesses, SMSFs. I think it's sort of revamp up to the top of the list again. 6 members, so the balance could keep growing again. Losers, not too many, right? Unless you're not doing the right thing. Yeah, not too many, because as I said, this is an election budget, well and truly. So cash users, a black economy, right? So and I didn't mention this, but I think in going forward too, like $10,000. And if you are dealing with a business, $10,000, you could no longer, it will be illegal if you pay to a business for something which is being done over $10,000. So that is a provision that's going to be put in for cash users. And data matching, obviously the ATO is getting extremely good at that, and it is partway through the program, and this is further extension of it. In fact, this budget has got heaps of integrity measures in it. We haven't mentioned a whole list of them. There'll be a lot of data matching, obviously with the revenue office. And one which was mentioned was, we'll look at pick up these, you just register new cars. In fact, used cars as well, and it's not gelling with the amount, obviously, which are being reported on the tax return. So those all the things which will be data match and will flow through the system. So I think the losers are pretty much those in those categories there. So given the time, I think we're pretty much at the stage where we are getting to the Q&A. So I'm not sure, Nigel, if you have any questions, or fire away. Let's see if we can take them.
Yeah, sure. Thanks for that, Keith. It's been a few questions, probably not as many as there have been in other years. We've answered a couple of the more simple ones directly, but I think probably the one which you answered, but it did come up again, was that with the notice of intention changes to be included in the tax return, does this actually mean that we don't have to still put in a 290, 170 when the contribution is made?
Yeah, I'd just like to clarify that, and I'm sure I did say it, that nothing has changed with that. We need your 290 notice of intent sent to us, and for us to acknowledge as well. What this change is an additional requirement by the individual to when they put in a tax return to confirm that they have sent in a notice and obviously had a confirmation and acknowledgement to be able to claim the deduction. Yeah. So keep on sending the notice as you would, and make sure you do, because obviously this first year that you may have more notices than normal. Obviously bearing in mind that more people are able to contribute and get deduction this year. Yes, definitely notices must come in.
We had a couple of questions around the work test exemption and how that's going to operate on a practical level. I think the first question revolved around whether or not you could use this where somebody turned 75 to actually make a contribution when they turned 76. As we know, I think it's what 704, Reg 704 sort of says you can't make any contributions after after turning 75, the 75th birthday.
Okay. Again, look, we shouldn't be stretching what the rules are intended to do. And I did say that the two rules are totally separate rules, right? We got to comply with each rule separately. And the work tests, in fact, if you look at the point on the slide, it did say 65 to 74 as well to start off with. So beyond that, it would not seem to operate. Plus the fact that separately as a contribution rule, you couldn't contribute beyond 75 unless it was mandated contributions. So on account of both, I think you'll be stopped from firstly by the work test rule, but let's wait for the provisions. Secondly, even if that got through, that you could have a work test rule applying beyond 75, then the contribution rule would have stopped you anyway. But I think both of them will stop you separately, individually.
And then there's quite a long question. I hope I'm going to sort of try to summarise it a bit. And the question revolved around the fact of using the bring forward with this rule. So essentially, I think the question was somebody's 64 on the 1st of July, and they contribute, say, $110,000 to trigger the bring forward. They turn 65, say, on the 1st of January, and they're not working. Can they still use the bring forward?
Well, again, back onto my previous question too, is treat those two rules separately. Yeah. So the 3-year brought forward rule hasn't changed. So if you trigger it, then certainly you could obviously use it upfront or the next 2 years rather than 3. Yeah. Then once you know that you are able to use the 3-year rule, and it could be a year where you say, look, I can then put in 170,000, right, to complete that cycle. Then that 170,000 that year you happen to be 66 years old, then you would need then say, I need to meet the work test, and therefore, yes, then you could perhaps rely on that rule. So remember, the work test rule is really looking at, okay, I need it at 66 years, at age 66 in that year, and I've got a 3-year brought forward, and based on this new set of rules, did I meet the work test the year before? Right? So treat them two separately, and yes, you can have the brought forward 3 years and completing it, but work test, you need to meet it separately as well. So potentially, I think, forgetting your question, but I think potentially, yes, you could. Yeah.
One question I think we can answer very quickly was, will the self-managed super fund trustees need to be updated to go from 4 to 6 members? I think the answer to that one is going to be definitely yes, because the rules, I mean, the deed will still take priority.
Yeah, I think you need to review it, right? Some deeds might say, look, whatever the legislation says, but it's probably not bad to, especially once we get the provisions, to have it reviewed to make sure that there's no problems, that we can certainly go on the 6 members. So I would urge you that if we're going down that path come on July 19, certainly, to allow that rather than it hasn't got it in there, and the deed is perhaps a bit more restrictive, and therefore you'll be in trouble in that despite the fact that legislation says you could, but then your self-managed fund can only have 4, right? So it can be more restrictive, but certainly yes, you would need to think about amendments. Yes.
And then a few questions revolving around the inactive accounts, and obviously considering the question of insurance being stopped that you brought up and how dangerous that could be. And I think essentially what the questions are asking is that do we have a definition of an inactive account? Well, one of the questions was saying, well, what happens if you have an account that's got $6,000 under $6,000 and the only thing that's happening to it is insurance contributions are coming out? Is that defined as inactive? Sort of my memory tells me that the definition of inactive revolves around contributions rather than things coming out. But can you remember anything how to answer that one off the top of your head at all? Or is that something we need to get back on?
I believe that's the case. I think it mentioned about 13 months, no contributions. But there's the exposure draft coming up too. So I think it just obviously before it happens, we will need to sort of confirm as a ministry exactly what that means. But at this point in time, I think it's yet 13 months without any contributions being inactive. I thought you said you didn't have many questions.
No, well, there's been a few, and there's actually a whole stack have sort of come up now, which I think we might have to go back to and answer generally. But there was a question regarding the pension loan scheme about whether you could use retirement village property as security. I know the definition within the Act says any property, any real estate, but of course retirement villages often have those exit fees and things. So I'm not really sure how that would pan out.
Yeah, obviously it's got to be a property that you own and can be charged upon. So look, I wouldn't know the answer top of my head here. So if something is sort of legally owned and it can be put a charge on, then it's something that we could certainly look at. But I'm not exactly sure how those ones are, whether you could even charge it. I know they've got really weird rules about those ones and exit fees and so forth. So look, we'll have to look at that one if if we could or not. Yeah. So.
Okay, there's another question here about the 300,000. I'm reading off the computer here.
The work test.
The work test. And is the 300,000 total account balance for work tests, does it only apply to the accumulation account?
No, it should be drafted in terms of the total super balance, right? So those of you who attended session with me on total super balance, you all recall what total super balance means, which is anything in the system, right? Obviously accumulation plus pension, subject to obviously modification for if you have a defined benefits as well. So it'll be along that line. It'll be the way that, for example, the $500,000 5-year carry forward total super balance be used at 1.6 million NCC. That same total super balance should be used in this context, and it will be measured as at 30th of June of the last financial year. Does that answer the question, do you think?
Yeah, I think that answers the question. I think it answers the next question as well, which asks whether or not the index pensions or defined benefit pensions are assessed for TSB, in which case the answer there is yes. So they're all captured inside that because they have an accumulation balance or something, I think.
Yeah, the TSB for defined benefit indexation.
Yeah. For that 300,000.
Yeah, okay. And you said that you think it would be. Can I differ from different from you, Nigel?
Certainly.
I think it's not. I think it's defined benefit whereby when it's counted at the start, that would be the balance which would be included. But of course, we don't deal too much with defined benefit. But if an advisor has got that particular one, we certainly need to think about that one a bit further. But I believe it's not. It will be counted at a point when the defined benefit it commenced, or as at 1 July when the new rules came in last year. Yeah.
Okay then. I think that probably there's lots of other questions in here. They're all getting a little bit complex and the time is going on. So do you want to shall we keep going a little bit longer, or do you want to call it quits?
Yeah, I think I've already done over time, right? Most of you know I usually do over time. But so look, in the interest of getting people off as close as the time that I say I would, let's sort of email directly. Unless you can see anyone which is really, really exciting that everyone should know. But otherwise, assume that we can just, whichever ones we haven't answered, is to just directly email those ones, yeah? Or at least you can, yeah.
Yes.
Thanks, Nigel.
Thanks for that.
Thanks very much for attending. Look, I know it's not much of budget. Like, there's still a few things there, and I thought it was going to be a 10-minute sort of, budget speech to you, but obviously I'm wrong. And obviously there's been a lot of interest with a lot of questions. So let's sit on that, think about it, right? And we're next few weeks, important, we think about our clients, and let's get again together next year, this time for the next budget. Thank you very much.